Industries and talk a little bit more about what the expectation is when it comes to numbers and how we expect each of their verticals as well to perform. Probal Sen is now joining in, VP Equity Research at ICICI Securities. Probal, I think what's taken everyone by surprise first up is that it's not traditionally on a Friday and it's not toward the fag end of the earnings season. The fact that it's happening on a Monday, do you think we can expect anything different? And by and large, what's the overall expectation from Reliance Industries?
Um, I wouldn't want to speculate too much on what the change of the day really means. It can be as simple an explanation as the availability of a board. Yes, traditionally, Reliance tends to release results on a Friday, but there have been instances in the recent past where there's been a couple of days here and there that's happened. So, I don't know what to make of the change of day, as such. I think it is going to be a slightly weak quarter. I think it's continuation of the trends that we saw in Q1 as well. The fact that downstream margins are, remaining under pressure is something that's going to reflect in their numbers as well. So to that extent, I think YOY numbers should actually show a low to mid single digit decline. And on a QOQ basis also, it's more of a flattish trend that we expect on an overall basis. Specific segments, obviously, here and there would be, divergent. Specifically, Geo, I think probably will have a strong quarter, but OTC, oil and gas, even retail to that extent, not looking too exciting for this quarter. So the H1 is shaping up to be a slightly muted quarter compared to slightly muted period rather, as compared to what we have really seen over the last 2 to 3 years, where there's been just strong earnings growth through and through, quarter after quarter.
A simple, straightforward question. What will it take for Reliance to start outperforming? In this decline, Reliance has led the market rally. When markets go higher, Reliance is always on the back seat. Do you think it's largely because of technical factors that Reliance is underperforming, or there is genuine concern around the way earnings trajectory is moving?
I think if you look at what has happened over the last 3 to 4 years is that earnings growth has continued to be ahead of peers of similar size. Not that there's any company of similar size, but in a similar market cap range, their earnings growth has pretty much been an outlier. But at the same time, capex has continued to rise up quite substantially. What that has basically meant is that return ratios and FCF yields have obviously been slightly muted. Now, over the last 3 to 6 months, what has exacerbated the pain perhaps is that even earnings growth seems to be slowing down. Because while consumer businesses probably still continue to do well, and there are expectations specifically that Geo will really, really drive earnings growth over the next 2 to 3 years, the trend in downstream earnings, if you really see, given the global trends in terms of refining as well as petchem, I think that is obviously an additional pain coming through, which will probably suppress FY25 earnings at the very least. Now, in terms of triggers, I think two or three things can happen. One, a slowdown in terms of capex outlay, which markets have been looking forward to for a long time. As and when it happens, will have a direct bearing on FCF yields and return ratios. Two, a return of momentum, specifically in the retail business. If you really look at it, the last couple of quarters, the kind of YOY growth momentum that one saw over 22, 23, and 24 in terms of retail has also seen a little bit of a slowdown. So a return of growth momentum there would probably be a good, driver of success. And three, as and when milestones come in the new energy business, I think that's something that will basically support earnings to a great extent in terms of momentum.
That you're expecting when it comes to the outlook on the new energy business and what the potential capex outlay would be?
Sorry, if you can come again with that question.
Anything on the outlook for the new energy business and what their capex outlay could be that they could outline?
I think they have stopped really giving specific capex guidance on a quarterly basis. We will probably get a little bit of color in terms of what capex has been done in the first half. If you remember, the capex plan overall is about 75,000 crores in the initial phase, and with the milestones that they have announced in the latest AGM, one would expect a significant portion of that capex to start getting spent in FY25 and 26. But it's difficult to talk about phasing since they really don't talk about specific capex guidance at this point of time. So, but I would expect that at least 15 to 20% of their capex will probably get spent in this year. on that segment.
Or price target for Reliance, 12-month price target and a 3-year price target.
So if I look at what our price target has been, we currently have a fair price target of around 29.70 on the name, and frankly, our target price has been in that range between 2,800 to 2,900 or so on. And our rating, is obviously cognizant of that. It's basically been between a hold and a reduce on the name for the last 1 year.
For you to, let's say, make the rating change from hold and reduce to neutral and buy, I mean, what is that one number or one figure or one trend you would look at which will change your view on the business?
No, I think, as I mentioned, I think an improvement in terms of the return ratios and FCF yields is what we will look at. Earnings growth, given that they're a major 40% of their business is still in a highly cyclical business segment, that's something that we can live with in terms of earnings being volatile or being cyclical to a certain extent. I don't think that that's something that they can control to a full extent. And consumer businesses, our sense is, while there could be a little bit of a slowdown in retail, will come back. So from an earnings growth perspective, that confidence has always been there, that mid to double digit, high double digit earnings growth will continue to sustain over the next 4 5 years. But when this is basically complemented by an equivalent improvement in actual cash flows and FCF yields, is when we would really start to become more bullish on the name from these levels.
Probal, away from Reliance, there are reports which are suggesting that the government is most likely to cut APM gas allocation by about 15 to 20% on consumer gas companies from about 16th of October or so. Firstly, do you think this is going to happen in the first place?
I haven't heard anything from the CGD companies that would suggest that. But if it really is a function of what kind of production numbers they are seeing from the fields that actually supply these priority gas supplies, number one. And secondly, one has to keep in mind that there's a lot more new CGDs that are also coming up, and they have their own gas requirements. And the government will obviously try and spread out this priority gas allocation as much as possible, including for the new CGDs as well. So it may be 5%, it may be 10%, but but directionally, the APM gas allocation will continue to reduce for city gas companies. I think that is something that is taken as a given. The extent of that, I really don't know whether it's going to be 15-20%. I don't have any specific information.
Correlation between Reliance, GRM and crude. Crude goes higher, GRM goes higher. GRM goes higher, Reliance will make more money. Then came this era of windfall taxes, which means that when GRMs were going higher, a company like Reliance or refining companies were not making money. That was something which applied to others also. How do you see in the light of the geopolitical tensions, the pure refining cycle moving, given that right now I don't think there are any windfall gains? So are we in for a cyclical uptake in GRMs, which is 30% of the total revenue, 30% of the total business?
The correlation between crude prices and GRMs actually holds if the increase in crude prices is led by demand strength. Typically, what is interesting about this crude price rally is it is only driven perhaps by apprehensions about any supply disruptions, specifically on the Straits of Hormuz, which is essentially what Iran can actually potentially disrupt. Even the disruption or reduction of Iran's oil exports is something that can be easily offset by the excess supply of oil that there is in the market, including the spare capacity that other OPEC countries actually have. So these are apprehensions about supply that have driven crude price higher. We don't really see, any specific signs that demand is actually so strong that can drive GRMs higher. So in this instance, I would perhaps disagree with that assertion that crude prices higher will automatically mean GRMs actually rise up to that extent. Yes, there is obviously some sort of a lag. There is some upward correction that can happen. But as we have really seen the physical market signals in terms of demand, in terms of product inventories, those unfortunately continue to remain bearish. So I would say that if crude prices have gone up by, let's say, $7 or $8 from their early lows, I wouldn't necessarily advocate crude product prices would go up by a similar extent. It could probably be half of that. Our best case scenario is Singapore margins go back to somewhere around maybe around $4 from the current lows of 2.5 to 3, and basically sustain there. That would provide some relief to the downstream companies. But no real strength in refining is something that we are building in as of now.
Sure. Probal, great to have you on the show. Thank you so much with that analysis on what to expect from Reliance India.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.